Okay, everyone, let's get started. So this is the last part of the series on really positioning IUL in the marketplace. One of the reasons we very much champion carriers like North American and European Insurance is due to the fact that they have a strong breadth and depth of their portfolio. So as we start walking through this presentation, you'll begin to see that, conversation starters with clients looking for more permanent insurance or looking for, opportunities to look for performance inside of their products. North American is very well positioned to carry those conversations, not just in the individual market, but in the business markets and as well. So we're going to give Chris a chance to kind of open up some doors there and give us a bit of view into how to position some of their products in the marketplace, and from here on out we'll really be focusing on positioning the right kind of planning strategies and products with North American and our ongoing series over the course of the year. All right, Chris, we appreciate having you on today. Why don't you, if you're ready, you can give this thing a go.
All right, thank you, Paul, and thank you everyone for taking the time to be on here today. As Paul mentioned, this is the fifth and final part of our Demystifying IUL series, and today we're going to be talking about how to sell. If you have not seen the other ones, I do invite you to go to Penny's website. They do have them recorded out there, and give those a listen. It really kind of will then help tie in this final one. But obviously, with the other four, we learned about how IULs work, things of that nature. That's great. How do we sell them? So let's get started here. What we're going to talk about today are our popular sales concepts that we have here at North American for our IUL portfolio. Obviously, we need to find out what clients are the best for IULs. We're going to go over a few more illustration tips, even though we covered that last session. We're always good to rehash that. And then, of course, most, I think, more importantly, is product selection. We want to make sure we're putting the client in the proper product for what they're looking to do. So some of the popular sales concepts we have for our IUL portfolio is income replacement with an emergency fund, using life insurance to help supplement retirement income. That's a big one. Using IUL for buy-sells, executive bonuses, estate planning. Obviously, it's very good for 1035 exchanges. We have more than this, but this is just some of the main ones that we use our IULs for. So just to start off, we're going to look at income replacement under cash value provides. Obviously, we have death benefit protection during the working years. So with the life insurance, if the main individual that's insured happens to pass away, you can use the death benefit proceeds to help pay for any income replacement, things of that nature. What does the cash value provide in this policy? Well, an emergency fund in case something happens, disability, you name it. Premium flexibility. If they lose their job, you can maybe not make the same amount of payments you were paying before. Or if you get a raise and want to put more income in, if the policy allows it, you can put more money into it. Obviously, control. Being a UL, you have the opportunity to control how you want it to work. Tax-deferred growth. Of course, we're not any growth that happens in the policy, you will not be getting 1099 for it, as long as you have it set up properly. And competitive performance. Here at North American, we have some of the strongest caps and pars out there in the industry. Obviously, a very big sales point, especially from like Susie Orman, is buy term, invest the difference. Well, that's great. Term is cheap, sure. But what happens if you purchase a term that doesn't have a good conversion option and your health is no longer there? One of the most important things you can do is ensure your health. If you're healthy and you get an IUL, that may be the only policy you're ever going to need again. And with investing the difference, you're not sure how other markets are going to work. We have a pretty good track record here at North American of the kind of percent growth you're going to have here. Plus, none of the money is actually in a market, so a lot of people, if they're buying term, maybe they're investing in the markets, they could end up losing everything they had. So you just want to make sure that you're looking at different scenarios when you are purchasing the IUL. If other people are coming to your clients with, like I said, if you're out there pitching the income replacement and what that can do, and another agent is pitching the compare term and invest the difference, know that we have something to combat that. Basically is what we're saying there. So the main one that we do a lot for IULs, I would say, is using life insurance to help supplement retirement income. Obviously, income replacement during the working years in case the insured dies, But that cash value provides, once again, the tax-deferred growth, the generally tax-free income, via loans, making sure that, once again, if you did not make the policy and played within the rules set up by the IRS, those would be tax-free. The nice thing is there is no IRS contribution limit. So if you have an individual that, say, wants to start putting some money away, but they have more to put away than like $5,000 or $6,000 for an IRA, hey, as long as the death benefit makes sense, they could put $10,000, $20,000 into the life insurance policy. What happens if they don't need the money? Well, if you have a qualified retirement account, you're going to need to start taking those RMDs out at age 70 and a half. With life insurance, you wouldn't need to do that. If you didn't need the money, you could just let that cash value grow. Eventually, that death benefit's going to grow, just leaving that to your beneficiary. So, there's a lot of different. It's a lot more flexible using the life insurance. We want to make sure the death benefit. The death benefit is always going to be excess of the surrender value. Along with the great performance and the cash and everything you can get out of that, you also have the chronic illness accelerated benefits that are just that are part of the policy. So that can help if they're chronically ill. You can access some of that death benefit or cash value to help pay for those. You can't perform 2 of 6 ADLs. Also, the terminal, and then on a couple of the products we do also have critical, so heart attack, stroke, cancer, things of that nature. You can access money from your policy from that as well. The nice thing is that on our illustration software that you download, InsMark is part of the software package. It's available to all of our North American agents, and you can go in there and run different reports and compare the life insurance to other outside investments and look at internal rate of returns. And that really helps sell clients on, if where we use it a lot is, say, like the case I had mentioned before, maybe he does just have $5,000. So we're looking at maybe an IRA versus in an annuity versus a life insurance policy. We can run those, and it has graphs, and really, when you put that in front of a client, really helps hammer home just how good life insurance is, not only as far as performance, but you also get that death benefit. So that really helps, I think, really put it home there to why life insurance really works for that. Another one we use a lot, our IULs a lot for, are buy-sell agreements. Now, I know typically most people think buy-sell, well, that's it's a 10-year term. We just, I'm buying it, so if I die, my spouse can, my partner can buy out my spouse and vice versa, because my wife doesn't want to be in business with my partner. But if you take a look at it with an IUL, you have more flexibility. So not only funding flexibility, value to buy out an owner in retirement, or value to supplement funding other buy-sell triggers, or an exit strategy. Let's say that my partner is 10 years older than me. Maybe he doesn't. I want to work to 65. Maybe he doesn't want to work to 75. Okay, well, I can use some of the cash value in my policy to help buy him out. Or if we just both decide to retire, we sell the business. Well, now instead of having that term we paid all that money into being gone, we have cash value in that life insurance policy we can now use to, take loans out, supplement income. So just, like I said, typically when you see the buy-sell, people think term, but once again, using it, just showing an IUL gives them more options. And a lot of times, especially when you're talking buy-sells, a lot of times you're talking small business owners, they want options. So I would definitely recommend showing an IUL. Once again, you can use the InsMark software to show how that can benefit the client. Executive bonus plans. Obviously, it provides death benefit protection, but obviously you get the cash value it provides in the bonus plan, helps supplement the retirement income, funding flexibility is just like everything else, and you can use the InsMark. So, obviously when you're talking executive bonus, you're bonusing one of your top employees, or you're bonusing yourself. You just, putting in as much cash as you can to really get that cash value up to help there in retirement. And estate planning. So, we have some IULs that are guaranteed, have a guaranteed death benefit to maturity. They have the chronic illness accelerated benefits. So that's good if you're doing some estate planning. What can eat up an estate really fast? Well, long-term care. Well, if you have a North American policy, like I said, you can utilize some of that death benefit to offset those costs. And of course, with an IUL, you get the flexibility, the income replacement, the exit strategy, and the control. Now, typically when you're talking estate planning, you're talking like a second to die type policy. And we have one here at North American, our survivorship GIUL. It is not a guaranteed death benefit product. However, being that you are insuring 2 lives, that really takes down the cost of insurance. I have actually seen illustrations and ran them myself where if the individuals are, say, like 55 to 60 years old, both in good health, running at the minimum at current cost of insurance, it still guarantees that death benefit all the way out. And our minimum is 3%. That's guaranteed. And we've also never raised cost of insurance on a North American enforced policy. So if we hold those to be equal, that we'll never raise cost of insurance and enforced policy, and for some reason we have to go with 30, 40 years of the minimum, and it still guarantees out. You can do the math on how that non-guaranteed on an index that's say 8.2 or 8.3% is going to look down the road. I mean, just the cash value in it is just huge. So if you have individuals that are looking for a second to die, even though our policy isn't currently a guaranteed death benefit product, it does look very good in comparison to other policies out there, and we do sell quite a bit of it. So I would definitely invite you to ask for an illustration or run one yourself and see how it stacks up. So basically what I'm saying is don't be afraid of the fact that it is not a guaranteed death benefit product. 1035 exchanges, with our product design, we have very good and competitive products. So if you're doing a 1035 exchanges, why would an individual do that? Well, they want to get more coverage for the same premium. Maybe they got into a product that's got some higher COIs. Or maybe they want to have less premium for the same coverage, or better cash value growth potential, or a guaranteed death benefit, or just other benefits. Where do we see a lot of our 1035 exchanges? Well, they're in older UL policies where COIs have now been recalculated. These things are going to blow up. So what do? You 1035 it to like a guaranteed builder or things of that nature, where now you have a guaranteed death benefit. You have some chance for some cash accumulation. Oh, and by the way, we're going to give you access to our accelerated benefit endorsements as well. The chronic, the critical, and the terminal. A lot of the older policies aren't going to have that chronic portion on there, and that's a big selling point these days. Or just like I said, better cash value potential with our indexed ULs. Got a policy, maybe a whole life policy. Hey, it was great. It got some cash, but it's not going to really do that much more. The potential isn't there. Put it into a builder. Now you have that opportunity to get better cash potential growth. So, you guys know what 1035s do, but obviously it's a big market for that. So, who's a good IUL target client? We don't want to be pushing IUL to people that don't want it, obviously. Like with anyone, of course, that needs life insurance, there's a death benefit need. We don't want to be selling it to someone who's already got more life insurance than they need, because as it says in the second bullet there, the desire for cash value is a secondary goal. The first priority North American always looks at is the death benefit need. And we want to make sure too that we're giving them enough death benefit. So if they really want to maximize their cash, maybe their death benefit goal isn't in line with what they need. Maybe they need more death benefit. It's also a client who's looking for potential or better return than a fixed interest rate. Obviously, fixed interest rates are low right now, so IUL sales, that's why you're seeing them, every year being higher and higher and higher because of that potential for growth out there. And they're looking for protection against downside market risk. So kind of the opposite, the other individual. Maybe they have their money currently in a more risky investment, and they want to protect against that downside risk, but still feel like they're participating in the market. That would be who your prototypical IUL client would be. So just to go over illustration tips again, I know we had briefly, we went over this last week, but once again, when you're illustrating, we want to make sure that we cover the death benefit that's needed. We want to make sure that we're selling them enough death benefit. We want to identify secondary cash value. When is the value needed? So are they going to want it for, maybe they just had a child. They're going to want it in 18 years when that child goes off to college to help supplement that. Or maybe they just want it at age 65 when they retire. Maybe they're going to retire at 67 or 70. Maybe they just want a lump sum or a certain amount that they know they're going to need down the road. Maybe they have an idea when their house is going to be paid off and they want a certain amount of cash. We can run illustrations to figure all that out, but that's the secondary goal compared to the death benefit. And then the client, agreement on assumptions. So, we want to make sure that we're doing a good job of field underwriting. Obviously, we don't want to just assume everyone is standard because they may not be. We want to ask the right questions. So we want to get as close as we can, obviously, without underwriting. What kind of rate class we're going to be? What type of interest rate are they comfortable with? Our max illustrated rate on the annual point-to-point is 8.2%. We came up with that based upon our 13.5% cap, geometrically back tested for 30 years. So is that a true rate of return? Indeed. If you had your money in this 30 years ago, that's what it would return. Are some people not comfortable with that rate? Obviously. So you want to make sure that you are using a rate that the client is comfortable with. To that end, if you are in a competitive situation, though, you want to make sure you're not just say if the client says, I want to see 7, you're not just showing 7 for each company. If the other company's max illustrated rate is 7.5 and they're showing 7, North American is 8.2 and we're showing 7, you can see how the discrepancies are. It's not apples to apples. So we want to do what we want to show the client what they want to see, but we want to also make them aware that not all index ULs are the same. Each one is set up different. Each pricing is set up different to be able to handle different caps and things of that nature. What loan type will you be using? Variable, fixed, zero, net cost zero loans. Normally we talk about using a variable loan because ours is capped at 6%, and then based on our illustrated rate, you can show some positive arbitrage on that. But maybe the client's not comfortable doing that, so you just want to ask those questions. And then you want to consider showing illustrations with another assumption. And really what we're saying there is if a person, client says, okay, I have $5,000 a year to put in this policy, what's the max cash I can get? You can show that, but what happens if all of a sudden down, 5, 10 years down the road, now they want to start putting in 7,000 or 8,000? Well, if we solved for just that minimum, they may not be able to put any more money in that policy without it becoming a mech, and that kind of defeats the whole purpose of maybe what we were trying to do. So maybe show some other assumptions. Say, okay, well, here's one showing 5,000, and then in 5 years we're putting in, 7,000, and then after 15 we're doing 9, and then 20 years out we're doing 10. You can just show them those different options, or you could show maybe an increasing death benefit type instead of a level. So just want to make sure that we're giving them more than one thing to look at. And then, of course, we want to be aware of changing conditions. So, death benefit needs, premium flexibility, income flexibility. Just ask those questions down there. Do you see any major, expenses that you don't have now? Like I said, maybe you have an individual who's in 10 years going to have to pay for some college for their child. Maybe they won't have the money to put into it, so you could scale back the premium and just pay minimum for a few years to keep it in force, then make those payments again. Or income, maybe they need, maybe they want to take a leave of absence and then go back to their job, or maybe they're going to switch jobs. Maybe they want to get out of the corporate world and open that restaurant they always wanted. So maybe they need some income supplement for the first few years till the restaurant gets off and going. Just talk it through with your clients. They're your clients. So, when you're asking the questions, if they wonder why you're doing it, you just say, hey, I want to do what's best for you so you have the best policy you can possibly have down the road. The worst thing to do would be to sell them a product that 15 years, 20 years down the road isn't doing them what they want to do and isn't doing them any good. So you want to ask those questions. So if they were saying, well, you asked me that, hey, I just want to get the policy that's best for you, design it the best way possible for what you want to do. So obviously product selection is very important when you are talking about what the client's needs are, what they want to accomplish. We have 4 IULs here at North American. We have our Builder IUL, our Rapid Builder, our Guaranteed Builder, and our Survivorship. So we'll go into those in a little bit more detail here. Our Builder IUL is our high cash value growth potential product. This is our kind of our flagship, our cash out, 20 years, that's going to get us the most cash. It is a non-guaranteed death benefit product. That being said, if you paid the minimum on this product for 20 years, that death benefit would be guaranteed. We also, you are able to, at age 65, we have a rider in there that can guarantee a portion that will take cash value out of it and guarantee a death benefit amount. So let's just say that an individual starts this policy at age 40. Okay, it would be, death benefit would be guaranteed for 20 years. Then at age 65, let's just say there's $500,000 of cash in that policy, and they say, I want to have $200,000 in a guaranteed death benefit for, they have 2 kids, so $100,000 for each. We'll take the cash value out, do the calculation how much it would cost to guarantee that $200,000. The rest of the cash value, all the way up to 0, you can take out for loans. So even though, like I said, it's non-guaranteed, it can be. And where we mostly use this one for is our income replacement, helping to supplement retirement income. You see there, BuySell, and executive bonus plan. So, our Builder IUL is really our flagship product that we use the most on our IUL chassis. The next product is our Rapid Builder. It's a non-guaranteed death benefit. It has early cash value growth, hence the name, the Rapid Builder, as well as long-term growth potential. There's no premium expense charge on this particular product. That's the reason why it can get the cash growing a little bit quicker. We have early access to cash value. There is an optional waiver of surrender charge rider. There is a cost to that. Along with that rider comes a table shave, table 3-2 standard, that would be need to be elected prior to issue for that to happen. But really, it's effective for income replacement, helping to supplement retirement income, of course, business, BuySell, and the 1035 exchange and asset transfers. And that's really, that bottom bullet is where we use our Rapid Builder most effectively in our smart money sale. So basically what we're saying there, if you have a client with some monies in some poor performing, say, annuities, or if they're in savings accounts or CDs, or just money that they're don't have a need for at this very moment, that's getting a poor return, you take it and you just dump it into the Rapid Builder. It becomes a MEC. That's fine. Now you have better chances for returns plus a death benefit down the road, and that's where we really see a lot of play with our Rapid Builder. Our third IUL product is our Guaranteed Builder IUL. We've really seen a sales increase in this product since we kind of relaunched it last fall. It has a high growth value potential, much like our Builder. It's really effective for all those same things that the Builder is, but this particular product also has a built-in guaranteed death benefit component. So if you solve for the guaranteed death benefit to 100, no matter what happens in the marketplace or with our internal cost of insurance or anything like that, that death benefit will be guaranteed to age 120, paid to 100, or however you have it funded, guaranteed death benefit to 120. Now, with that being said, if you were to use it for loans or take a withdrawal, that will void the guaranteed death benefit portion of it. However, if you pay the loan back, it will then reinstate it. So you're asking, so where does this product best fit in? This is definitely not a product for an individual who knows they want to take loans out. you're going to want to go with the builder there. This is for that individual that maybe is a little on the fence of what they want. Hey, I like the idea of cash value, but I really like the idea of a guaranteed death benefit as well. You can put them into the builder, the guaranteed builder, and then if something happens down the road where they need access to that cash, they know it's there. But if they don't, they know they have the guaranteed death benefit component. And I don't have a slide for the survivorship, but I kind of went over that before. Just it's a second to die. We will accept a non-insurable second insured, and like I said, it really does well when you illustrate it because of those. Insuring the two lives, the COIs are so much lower that you can really get some great cash value growth in that particular product. So with that, here is my contact information here, 7:30 to 5 Monday through Thursday till 12:30 on Fridays, and my email and my extension. And of course, you can always get a hold of someone over at Penny as well. So with that, I would welcome any questions that anyone may have at this time.
Well, Chris, we appreciate you coming out and giving us, sort of the nuts and bolts on North American's policy. We definitely look forward to having you out and talking about some more advanced concepts coming up here in the near future. And we wish everybody out there a wonderful and safe day and have a happy holiday. So thanks for coming out, and we look forward to touching base with all of you soon. You guys all have a great day.